Hey everybody, this is Jim at SP500chart.com. It is a little after 5 o'clock on January 29th, 2013. We have 2 days left in January, and what a January effect we have seen. But before we take a look at it, as always, I need to tell you that the website and the video are for educational purposes only. Nothing stated at the site or in the video is intended to be used as investment advice. I can draw lines on charts, but you have to draw your own conclusions from your own research and make investment decisions that are suitable for your personal financial situation. I am not a licensed financial professional. I am just a guy who draws lines on charts. We're starting out today looking at a chart that we usually don't look at, and that is a daily chart, kind of zoomed in to the last 3 months or so, a little bit more than the last 3 months. And here is our month of January, starting right here with this big green candle, and then just this incessant inflow of money. And guys, you know it's true, and I hope I'm not insulting anyone's intelligence, but the markets go up when the money flows in. The markets go down when the money flows out. And if we take that to the logical extremes, when the markets get to the point to where there's no more money to go in, that's called a top. Because from that point on, money starts coming out, and typically in waves or patterns that that persist for a while. We are not there. We have been in a pattern of bullishness that started back in March and let's say late winter of 2009. The markets reached a point to where no more money could come out. So what happens? Well, all of a sudden then the markets become a sponge in search for moisture, in search for liquidity, which was plentiful. So let's just take a quick review of what has happened since March of 2009. Okay, there's a 3-day chart, and you can see this was the culmination of about 18 months of money just being squeezed out of the markets. Not like a short squeeze, but you know what I'm saying. The markets were just wringing every last dollar out of weak hands, culminating in that low on March 9th of 2009. Ever since then, we've had a series of rallies and sell-offs, rallies and sell-offs, rally, sell-off, rally, sell-off, and now we're on a rally. And the question is, where are we going to sell off? Well, one thing I need to show you is we have what I would expect, some resistance up around 1600. Matter of fact, I think if we look at it in one way, I think we came out with a 1585 as a fairly likely target. But I still feel that this market needs to take a breather, and the longer it goes without doing so, the more we see this, the more, and well, let's put it this way. The simplest pattern, a technical analysis. Try that again. The simplest pattern a technical analyst of the markets can spot is simple. It's an uptrend. And the higher an uptrend goes, the weaker the technical health of that stock is, or of that market or index. Because the higher it goes, without coming down, without pausing or without giving up some of those gains, then the more pent up pressure will be released at some point down the road. That's why a lot of times when you see a stock accelerate almost out of control, you suddenly will see uh, a counter move that ends up being a backbreaker on the underlying trend. Let me show you a chart that did that. Here's a chart of SLV, silver. And interesting to note, we had an inverse head and shoulders here with a target up in the mid 40s, and we were in the SLV was in pretty much in this channel. You could see this line right here, and then it just went hog wild and zoomed way up to 48, and then for the next year and a half, it's been a series of lower lows and lower highs, which may be close to turning around. But you can see the trend got busted. You would think, wow, that sure was bullish. No, it is bullish if you get out on that move. But you can see that clearly this sudden acceleration, as people, silver was all of a sudden on everybody's map, and everybody, I got to get me some silver. And that's what caused this. It got over the nicely controlled, call it organic rise from these lows of 2008, and then suddenly it accelerated, and that just created too much selling pressure, and ever since then silver has been struggling. So as I look at this particular resistance line right here that had been working for more than 2 months, as I see the S&P apparently being willing to take out this top line, I have to ask myself, is that a sign that we are now seeing panic buying? Not necessarily by shorts who are covering, but panic buying by uh, people who are afraid that they might miss the big rally. Well, guys, the time to get in on that big rally was way back here. As a matter of fact, one of the first things I did back in chart reading, and really this is almost why I'm here doing this today, is I met some folks back in these really wild and hairy days on a message board, and I pointed out this inverted head and shoulders. Now everybody else was saying we're headed down to 400. I said no. As a matter of fact, by early summer of 2009, I said this market's headed up to the mid 1300s as a minimum. And I'm not saying that because I'm smart. I just recognize the pattern. I read the books, so I knew what this was. But so anyway, making a long story short, I'm wondering out loud right now just what is going on in the S&P. This has been really a if you allow for this being a little corrective move right here that lasted about eight and a half days or so, call it 8 days, the S&P has run from 1340 to 1507 with hardly a hiccup. And that's a pretty good run. And, I think when we saw that this channel back here, when it broke out, we knew, well, then this downward move was likely over. When we saw this channel right here that lasted 8 days break out, we knew, well, that down move is likely over. But I'll be honest with you, I never saw the kind of incessant buying. It's almost like as I watch the markets every day, it is almost like there's this percolation going on of this constant buoyancy where the sucker just won't go down. Folks, I'm not going to tell you what to do, and I don't want to color your outlook. That's really not why I do this. But I just kind of shake my head at it right now and say, this has to come back a bit. It needs to. It doesn't have to, but for the market to be healthy, I think we need to come down and take out this 1500 level at some point and come back down once again to the at least the 1470s and hopefully to this rising turquoise line right here, which is currently in the low to mid. Well, currently it's around 1436, but we're not going to come down, and I don't think the markets are going to lose 70 points in one day. Um, I hope not, because that means something's happened. But anyway, guys, that's just what I'm seeing here. Now, yesterday I pointed out what appeared to be a an ascending triangle. This ascending triangle gave us a little head fake this morning, and then it took out that 1502 resistance. We now, I think it's safe to say that we should see 1514 very very shortly, based upon the depth of this little pattern. Um, so, like I said, there was this little dip down here of roughly 1 and 3/4 points, but really inconsequential. The market quickly rebounded, then broke up over this resistance line, and it looks to me like we now can, from this 3-day old pattern, we should be able to predict. And I know you're thinking, boy, big whoop, another 6 points, 6.5 points. Well, that's what the chart is showing us. So that's what we're left with. So we were in this little orange channel. Now we've consolidated for 3.5 days roughly, and now it looks like we're headed back up, and we should have a target of 1514 to look forward to. So guys, I think the basic rule of thumb is for tomorrow the same it's been for what feels like weeks now. This is the important line, at least in the short term. As long as this bottom line holds right here, obviously it goes without saying, the market keeps going up in that channel. But when this line breaks, then I think we are in for a move down to at least the 1470s, and more likely, and I'm hoping that we have some additional selling pressure to really bring this market in a healthy counter trend back to the 1440s, where we would then look for signs of a turnaround to go long in a larger way, at least for me, than I am right now. So, guys, it looks like we're seeing the effects of, if we are to believe the headlines, this move that we're seeing in January looks to be the retail investor finally saying, boy, howdy, the markets are just perfectly healthy. Look at what's going on. I can't miss that. I'm going to make a fortune. And when everybody does that, it's time to watch the charts very closely. So, guys, I think we're getting very close. Not necessarily to a top, because it hasn't formed yet. But I think we are getting close to the kind of psychological climate that is conducive to the formation of a market top. We have not had that until now. And I'll be honest, I thought there were times over the past year to year and a half where we might be making a top. But the one thing that kept gnawing at me was the fact that we don't have the psychology in place. It's not Go, go, go. The markets are safe. It was all of those other, quote, topping opportunities were taking place when things were still troubling and when money was still on the sidelines. Look for this move, if we get it, to the mid to upper 1500s, and I would watch that like a hawk. So look, stay with me. Thanks for watching, and I appreciate your support.